How's it going, everyone? This is Chris. Making a video here today. This is the Q3 2026 outlook. We're a little bit past the start of Q3, about a month in at this point, going into August, but I still wanted to make this video. A lot has happened in the last 3 to 4 months, a continuation from the previous video that I made in early April. So we're going to look at a couple things that we looked at last time, and also look forward for the next 2 to 3 months to see what could potentially happen. So definitely a lot of interesting things. I got quite a few slides here, and we'll just work through them one by one and go ahead and get going. So, all right. So first, we're going to start with kind of what did I look at last time in April. That was early April that I made the last video. This is kind of like my scorecard, pretty much like what did I project, and then what actually happened. So we'll walk through each one of these. The first one that I had was Hormuz. The Strait of Hormuz would be closed for weeks. Planned for months. Worst case scenario, we're planning for months, if not years. So at this point, we are almost 150 days into the closure of the Strait of Hormuz in Iran, and there's no clear end in sight. We're actually looking at further escalations at this point, so that did come true. Um, Jerome Powell out, Kevin Warsh in, and the Fed turns hawkish, basically meaning that they're looking at rate raises at this point. And Kevin Warsh is the new Federal Reserve chair at this point. We're not seeing as much fervor for doing quantitative easing as we were in the past. They're definitely looking at rate hikes, if not just holding rates as they are, based on what the rest of the market is looking like. That one came true as well. Oil-driven inflation raises. So inflation did increase for most of the year. It increased steadily since March, which was around the time when this entire conflict in Iran started happening. And then there was a slight drop off in June. So last month when they released the numbers, there was a little bit of a drop off. So good to see, but overall the trend has been up since this conflict began. I talked about Bitcoin as well. This is Chris talks crypto and whatnot, but always got to talk about Bitcoin. And so I was looking at months of downtrend ahead, and that was in April, and that so far has come to pass as well. So Bitcoin has continued its downslope right now. It's sitting around 65,000, and it's struggling to reclaim the previous highs at this point. So I think Bitcoin has a little bit more to go down, and it's one of the last things that I'll talk about on this video. I am optimistic for the future, especially going into the end of this year and the start of next year as well, to see what Bitcoin will do. So definitely not out of play at this point, but something that we'll continue to look at. The one where I did get it wrong, not necessarily wrong, but the timing was off. So I projected that the oil shock would lead to a downturn, a drawdown in equities. So stock market indexes like the S&P 500, the NASDAQ, and the Dow Jones. I thought we would just see an absolute drawdown with that. But we saw a huge surge in AI-related stocks over the last 3 months, really starting at the beginning of April. So around the 6th or 7th of April, it started a huge rally, one that we have not really seen previously in stocks. So, got that wrong. But again, I still believe that we're going to see a drawdown at this point. So I'll keep that one in my pocket. And the final one that we had was oil to $150 per barrel, and the new floor near 100. So price did actually fall back down below 100. I think somewhere it's sitting around 65 a barrel at this point. But I don't think we're out of the woods just yet. I know there's been a lot of what I would call "quote unquote" financial manipulation of the oil prices. They are not agreeing with the physical barrel delivery. So the futures price is one thing, but the actual barrel delivery price of the physical is something different. So I know for a fact that the U.S. has been shorting oil futures as well, so CL, MCL as well. And on top of that, they've been releasing the Strategic Petroleum Reserve, which helps you out temporarily, but in the long term, it really kind of hampers your ability to fend off further supply shocks, which we'll kind of talk about all that in a minute. So overall, pretty good calls, and I will stand by what I said back in April. I'm using, as always, I'm using the data that was present to me at that moment. I would have made that same call, and I still believe that this one's in play. I actually still believe that both of these bottom ones were in play. So if you pay attention, I'm going to talk about a lot of the points that I did in the last video as well. So go back and watch that if you have a moment. So this is the Strait of Hormuz, the Hormuz Strait. We get this from marinevessels.com, marinevesseltraffic.com, excuse me. So what we can see right here is like this is the Strait of Hormuz essentially, and we see that there's a lot of little dots here, little traffic and whatnot. These blue dots. When you have your green and red dots, that means heavy traffic. So we see like inside of the Persian Gulf, there's a lot of movement between Qatar and the UAE and Iran and people coming from up here and whatnot. There's a lot of pipelines that run this way, so people can get supplies within there without having to cross the Strait of Hormuz. So that is something that we're definitely looking. Definitely something that we're looking at, but it is a fact that the Strait of Hormuz is still closed, and that is a huge detriment to the world in general. Because I mean, at that point, we've essentially been cut off from the Gulf states' oil. So all the Middle East major oil producers, OPEC and all that, they just are not able to get oil out in the same way that they were in the past. So this is critical. And so at this point, I talked about 150 days. So I pulled this morning. This is Strait of Hormuz. It's a live tracker, and they got a lot of other good information, but I will just use this for now. We are 148 days into this closure, and that is a lot. That is a ton. So that's almost 5 months of shutdown to where they're not at normal capacity and able to, get barrels out in the way that they should. And this is another way to look at the Strait of Hormuz traffic. So this was, 2025, December 2025, January 26th, so on and so forth. And then the conflict happened on February 28th. So, we're fine. Maybe a little dip here, but we're fine. The average is still there. And then it goes to essentially zero. We see over here like the Brent crude price. So crude price has dropped quite a bit. I'm sorry. This is the crude price, the pink line. Crude prices ran up, and then eventually they dropped back down a bit as they were, making moves to stabilize things. But the Strait of Hormuz has essentially been closed, and there was a little bit of pickup, but we see like by the start of July that had all kind of faded. So there's really not that much traffic in the Strait of Hormuz at this point. So that's bad for the global economy. That is definitely bad for the global economy. Not something that I had. Not something that I was looking at the beginning of 2026, but hey, when stuff happens, you've got to respond to it, right? So again, this happened in late February, really essentially March of 2026, and we've just been moving on ever since. So we will see how this plays out in the next 1 month, 2 months, 3 months. Really, all you can do is play it day by day at this point to see if we will reach some type of peace deal or some type of agreement with Iran to where we can get things back to normal. Maybe normal is not possible anymore. I don't know. But again, like I said, we will take this day by day. And I was talking about this a little bit earlier, your SPR, your Strategic Petroleum Reserve. So this has been something that, post the 70s, there were oil embargoes and a lot of things with OPEC that caused the United States and the international, kind of energy organizations to say, we should have some type of buffer. We should have some protection that allows us to withstand any type of supply shock that we may have. And that's where the Strategic Petroleum Reserve came in. So we see this is like, what is this, 1985, 1989. So this is the early to mid 80s when we started filling this up. And this red kind of chart down here, this is the rate of change. The rate of change for the Strategic Petroleum Reserve. So if it's positive above zero, that means it's filling up. If that rate of change is negative, that means it is empty. So we can see like from the 80s, pretty much all of the 80s, it was filling up. 90s, it just remained flat. The early 2000s when oil was really ripping, we filled it up. And it stayed there from like 2005 all the way until about 2015, 2017. We started drawing down a little bit. And then during the Biden administration, we really pulled down. A lot of this was the Ukraine war, the Ukraine and Russia war. Which really kind of rattled the oil markets about 4 years ago. That was 2022. We see a huge drop off that we've never seen before right there. Just absolutely plummeted. In the span of a year or two, we erased what we had done since 85. What is that? We'll call it 1980, just for a round number. We'll call it from 1980 all the way until 2022. So that's what, 20 years, but 42 years. We erased all that progress in 1 year. And now, there was a little bit of an uptick post that, no real wars or major conflicts or anything. And now we have Iran. So this huge drop down right here is the Iran conflict. So we have drained this at unprecedented rates. And I believe this yellow line is your kind of minimum. So we are at the point where we are running out very quickly. So we do not have that buffer anymore, which kind of adds to my calculations and just kind of seeing where we could be at and how this situation affects us as we stand. The other thing that I talk about in reference to the Middle East is the oil and gas infrastructure that has been damaged. So I've actually worked in the oil and gas industry in one way or another for the past roughly 7 to 8 years. One thing I know for certain is that this is fixed equipment. It is, there's a huge upfront capital investment, and it's not meant to be, bombed or struck with missiles or anything like that. Once that is done, it takes months, if not years, to rebuild that equipment. If we're talking processing plants or distillation towers or storage vessels and things like that, those are not something that you can just order off of the shelf. You have to actually build those, and there's going to be a lot of capital that has just been lost overall. That stuff is, facilities being condemned because they cannot no longer operate. But let's take a look at this. This is just in the Middle East. We'll talk about the rest of the world a little bit later. But this is your war zone. So again, everything between Iran, around Israel, and so on and forth. So I'm looking more so at the actual number of hits. So Saudi Arabia, you've had several facilities be hit in Saudi Arabia. The UAE and Dubai, several refineries, petrochemical plants, gas processing plants, so on and so forth. Iran, obviously, South Pars. This is one of the largest oil fields in the Middle East. Karg Island Terminal. That's another thing too, right? So not only are the facilities getting hit, but if the export and import terminals, if those get hit as well, those take time to rebuild. So even if we stop this war right now, we stopped it today, it would still be months, if not years, before we get everything running back to normal, just because it does take that much time and raw material to be able to get these facilities back running feasibly. But you have other ones like Kuwait, Iraq, Israel, of course, they're in this conflict. Oman, Bahrain, and Qatar. So if we look at these, all this is 10 plus 8, 18, 25, 28, 31, 34, was it 37, and 40. So that's 40 hits in the Middle East alone, just of damaged facilities. So that is huge, especially if we're talking about how the Middle East is the major provider for a lot of the world's oil, and especially Asia. We'll talk about that in a little bit. This is the rest of the world, gas infrastructure damage. So keep these countries in mind because I'm going to show this a little bit later, show something else a little bit later. But the major ones that you have are Russia being hit, Ukraine being hit with 9. Russia's a much bigger country, obviously. All these different facilities being hit. Ukraine as well, gas facilities, fuel stations. Nigeria, this isn't really related to the conflict. And South America, these are a little bit different. And I mean, there have even been some ones in the United States recently. There was a little bit more hush hush, but I know like there was damage to a Valero site in Texas, down in Port Arthur, actually. I don't think that was related to the conflict, but the timing is very interesting because it did happen within that window. But yeah, there has been a widespread damaging of critical energy and petrochemical infrastructure that is not going to be remedied overnight. And that's a fact for sure. I mean, they don't have spare facilities just sitting around. They actually have to make this stuff from scratch. So we'll see how that plays out. But it is, in my opinion, that is not good for the masses, I would say. Looking at this chart coming from the Energy Information Administration, is the EIA. They actually just posted this not too long ago on July 9th of this year. In 2025, the United States produced more crude oil than any country out there. So, and that has been the case for a while, since about 2015, 2016, with the Texas oil, the shale boom, I should say, out in the Permian Basin, out in West Texas. We have been a major exporter and producer since then. U.S. is still number one. Our facilities are largely intact. Russia is number two. Huge country, huge oil and gas country. But again, they're in the middle of this conflict with Ukraine. So I mean, that puts a strain on them. Saudi Arabia, we talked about them in the Middle East. They are in the middle of that conflict. So that's one. Canada, not really involved. Iraq, right there in the Middle East. China, not really involved, but actually they are involved to a degree because they are considering. Iran is considering at least accepting the yuan, the Chinese yuan, for safe passage through the Strait of Hormuz. Uh, that would be a huge blow to the petrodollar, and I've talked about that in the past. So, Iran, like I said, right there in the Middle East. The UAE, the United Arab Emirates, is right there as well. Brazil, not really in the picture, but Kuwait is in the Middle East as well. So, what am I saying at this point? Russia, Saudi Arabia, Iraq, Iran, UAE, and Kuwait are that's like 6 out of or 7 out of the top 10 oil producers are under direct line of fire at this point. So I am a firm believer that over time energy prices are going to rise just because there's so much pressure on them as it stands. I think we've done things to mitigate that at this point, but just looking at where it's being affected at this point is something that we want to pay attention to. So we will continue. I mentioned earlier that, and I had this exact same slide in the last video from April too. So again, go check that out. I go a lot more in depth into the why as to why this is so bad, but now we're just touching the surface. So, looking at the different sectors of the world, like okay, so who is dependent on Persian Gulf oil? Who is dependent on getting stuff out of the Strait of Hormuz? So, U.S. not so much. We kind of depend on them for fuel oil, 60%, but we can make that up. Europe not so much. The UK a little bit for jet fuel, but the real hitter here is Asia. So China, India, Japan, South Korea, Singapore, Malaysia, Thailand, Taiwan. They do not have huge amounts of crude oil and crude oil infrastructure, and so a lot of that, especially if we're looking at fuel oil, they are 100% reliable on Gulf Coast oil. So if we talk about made in China or something, most of that is coming via water. It is getting shipped to you, and then once it gets to the United States, then it's flown around or done what it needs to be. But the majority of transatlantic or trans-Pacific trade is done via ship. So fuel oil is huge because that is what ships run on. Jet fuel is obviously what planes and jets run on. Diesel is what your heavy machinery and semis and stuff run on. And gasoline is just your everyday car. So what I'm seeing is Asia gets hit very hard with this, and that is, like I said, something that I talked about in the last video, and we're seeing those effects now. We've seen the rationing, we've seen different measures being taken on the policy level to kind of curb some of this demand and a lack of supply. Taking a look here at Africa, not really much. South Africa doesn't have a ton of oil and gas. They're not really reliant on the Middle East. South Africa more so than countries like Nigeria. But if we look at an average overall, we're looking at fuel oil being a major thing. So shipping is going to be constrained. I still believe that, especially if we're talking about waterways. But the next biggest one I would say would probably be diesel and jet fuel. So all of these things are important. So let's talk about currency indexes. Like, how has this affected currencies over time? This is a map of how the different currencies have performed since 2020. 2020 starts right here, and then you got 2021. What do I have here? So I have SXY, which is your Swiss franc, DXY, which is your dollar, EXY is your euro, BXY is your British pound, AXY is your Australian dollar. CXY is your Chinese yuan. Let me see, who else do I have here? ZXY is your New Zealand dollar, and JXY is the Japanese yen. So what sticks out here at this point? So since 2020, who's the winner and who's the loser? The winner has been the Swiss franc. They have appreciated severely, about 18% since 2020 over the last 6 years. Japan, on the other hand, has sunk continuously, minus 33% in the last 6 years. So you got to ask yourself, like, what's happening? and everyone else is kind of in the middle. At this point, the dollar is ever so slightly up. The euro, the British pound, Australian dollar, Chinese yuan is a little bit down, and New Zealand dollar is down quite a bit. But Japan for sure sticks out. So we're going to do some more investigation and figure out why exactly that is. I have the kind of answer at this point, but Japan is under some real strain at this point, and they are hugely important to the global economy, as we will find out. What would Japan do? I had these two people on the front screen, the thumbnail, and who are they? So this is the Prime Minister of Japan on the left. She just recently got elected, I want to say in late 2025. And then you have the head of the Bank of Japan, who is essentially the counterpart to the Federal Reserve in Japan. These two people are arguably some of the most people in the world right now, just because Japan's economy has gone under some major shifts over the last year, especially, but even before that. So let's take a look at the timeline for the Japanese economy. Kind of pulled some of these dates and laid them out. So what I'm looking back 1 year. So July of 2025, the Bank of Japan was at an interest rate of 0.5%. Historically, they have been at zero to negative interest rates for a long time. So for quite a while, it was actually free. And in some instances, it actually paid to borrow in the yen or to have yen, versus just holding the dollars. And this is where the yen carry trade comes in, which is what we'll talk about next. Takaichi is the Prime Minister who I just talked about. So this is Takaichi right here, Miss Takaichi. She was elected in October of 2025. The yen and Japanese bonds continued to fall at that point. She was big on stimulus. She's not huge on hikes and whatnot. So that was the reason that the yen and bonds kind of fell. Well, not the sole reason, but one of them. She's a little bit softer on hikes than some of her previous counterparts. A month later, in November of 2025, there was a 21 trillion yen stimulus package that was released to the Japanese people due to overall economic hardship. And this is before we even had the Strait of Hormuz incident happen. So they were going through it back then at that point, enough to release trillions of dollars into the economy in terms of the stimulus. Well, really hundreds of billions once you convert that to dollars, but still, regardless, it's a lot of money. December of 2025, the Bank of Japan increased from 0.5% to 0.75% for their interest rate. So if the interest rates increase, the cost of money goes up. Fast forward to March of 2026 / late February, that's when the U.S.-Iran war started. Oil absolutely spiked, and like we showed earlier, Japan is very much dependent on Middle Eastern oil to be able to do what they need to do for their daily life. So that is important to them. So between April and May of 2026, Japan, Bank of Japan intervened to the tune of 11 trillion yen. When the yen was near 160. So what does that mean? 160 yen to $1 US. That's the exchange rate at this point. And anytime that number reaches about 160, there's a good chance that Japan is going to start to intervene so that the yen can get stronger. The more this number goes up, so if it goes to 165 or 170, that means that the yen is getting weaker and weaker against the dollar, which is something that Japan obviously wants to prevent, because that hampers with trade and daily life and all that good stuff. June of 26, about a month or two ago, the Bank of Japan hiked rates to 1%. That is the highest since 1995. So we're looking back, almost 3 decades at that point, to a hike of 1% for their interest rates. Like I said, they have had a long stretch of having zero to negative interest rates for a long time. Recently, so I think as of last Friday, The yen was sitting at 163.8, and that is a 40-year low. So it has not been that low. The yen has not been that weak against the dollar for 40 years. So we are seeing a likely second round of intervention from Japan into the currency to make the yen stronger. I don't know if it'll actually hold weight, but we will see. And what we have coming up this week is the Federal Reserve in the United States and the Bank of Japan. They will be releasing their new interest rates. There are 4 more meetings for the rest of the year. So the Federal Reserve and the Bank of Japan each have 4 meetings. I believe that we will see hikes from both the Federal Reserve and the Bank of Japan, which is going to put pressure on your risk assets. So we'll talk about that in a bit, but it's definitely something that we want to be paying attention to, especially during this time. So I mentioned earlier about the yen carry trade. So what is that? So I said that it was either free or they would end up paying you to borrow in yen. And that worked for about 3 decades. So that yen carry trade only works when there's a gap between the rates. So if the U.S. is sitting at a rate of 4% and the yen is sitting at, I don't know, let's say 1% or 0%, that gap is 4 percentage points. But if the yen starts to hike and then all of a sudden now the yen is at 2%, all right, well, that gap closes. There's a little bit less arbitrage there. So what do we mean by that? So the yen carry trade, which is the forward carry, it allows you to borrow yen cheaply. The BOJ policy rate is at 1% right now, but it was even less. You take those yen that you've borrowed, you sell them, you invest in dollars, and you sell the yen for dollars, which weakens the yen, and then you buy higher yield assets. So it's $1 is yielding 4%. You borrowed at 0%, and now you're gaining 4%. So that's an arbitrage. They could invest that in equities, real estate, or whatever. Anything that's essentially getting you over that over your borrowing rate is going to be a profit to you. But again, as that gap narrows, that trade is less popular. And essentially, like I said, you're collecting this spread, that arbitrage, that rate gap between the U.S. dollar and the Japanese yen. So a lot of this is forex at that point. So what happens in reverse? So that's what going forward. If you do reverse, as that gap closes, you start to see a reverse yen carry trade. So if there's some type of shock, in this case, let's say the Iran war, that has the potential for Japan to change their rates and close that gap. And what happens then? Once that gap closes, it starts to sell foreign assets. Japan does. Japan starts to sell foreign assets, and they raise cash to repay loans. And really, not Japan. So at this point, this would be the borrowers at this point. So people in the U.S. So they sell whatever they put their money, put the borrowed yen into, whether it be real estate or equity or something else. They take those assets and they repay the loans, just because at that point the interest starts eating them alive. And then at that point, the yen gets bought back in the reverse carry trade. The strength of the yen goes up. So if we said it was at 160, that yen might break down to 150 or 140 at that point, which means that the yen is getting stronger against the dollar. And ultimately, it's a self-feeding loop. So that strength of the yen brings in more strength, more sellers of the dollar to get more yen at that point. So I think we're at the point of the reverse carry trade at this point. Like I said, this one worked for about 30 years. But when you have geopolitical events that force that gap closure, then it stops working. And it's not the same thing anymore. But the reason that this is so important, because so much of the U.S. Equities rallies that we've seen over the last decade or 2 or 3 have been a byproduct of them having cheap liquidity. And the Japanese yen was cheap liquidity via the yen carry trade. They were able to borrow cheaply and invest in basically risk-free other assets that were yielding much higher. That drying up of liquidity in the market leads to a downturn generally in equities and stocks and stuff like that. So yen carry trade is something that we definitely want to look at. I mean, this has been something that I've been talking about for at least a year or 2 at this point, just to kind of keep up with things. So. And if we talk about okay, well, what's being sold for these interventions? What's being sold to strengthen the yen? For the most part, it's going to be U.S. Treasuries and stuff like that. So, who is the largest holder of U.S. Treasury securities? They take all other countries that are combined, but Japan is number one after you've combined everybody else. Then you got the UK, China mainland, Belgium, so on and so forth. But as we can see here, Japan is kind of in a class of its own. It holds so many foreign U.S. securities that if they start dumping and to save their own economy, to save themselves, that can have major consequences over on the mainland on the U.S. for us, especially in terms of asset prices. So I think that will be something to heavily watch in the near future, just because Japan is important. I think they're one of the most important countries out there right now, outside of the U.S. and Iran, just because they hold a lot of power in the financial world. So speaking of the Bank of Japan, we also have the Federal Reserve in the United States, and as of recently, Jerome Powell is no longer the Federal Reserve chair. Those reins have been handed over to Kevin Warsh. He is the new Federal Reserve chair at this point, and his style is a little bit different than Jerome Powell. Jerome Powell was very big on forward guidance, kind of helping to give signals and lead investors to a certain direction, kind of give some type of guidance, um, you know, for what the Federal Reserve is doing. Um, Kevin Warsh is a little bit different. So one quote that he said here in the June meeting, which you got to take this with a grain of salt. All this data on Kevin is based off of one meeting at this point, and kind of what his background is. But one of the quotes was, "Press conferences are useful, but when you have one, you want to make sure that you have something important to say. We're not holding press conferences just to hold press conferences at this point. That's not what his MO is. He wants to look at the data and kind of let the data lead what else is going on. So just kind of looking initially at what has changed between him and Powell, you got a few key points. Powell talked markets through decisions, like I was saying earlier, but Warsh lets the data talk. The Federal Reserve statements got shorter, so they have a meeting every month on the release. Normally they do. That's not saying that they will moving forward, but Jerome Powell averaged 300 words, and Warsh's first address was 160 words. So that's like 60% less right there. 50 to 60% less. I think it's a little bit shorter, but price stability is now in favor of job stability, which the Federal Reserve has a dual mandate. What that means essentially is they are there to keep prices stable and to maximize employment. And so now what Warsh is saying is, hey, we're definitely going to keep prices stable, but jobs, we can let that fall to the wayside. Not in its entirety, but he has definitely picked the more important out of the two. And that is keeping prices stable for the American people. And one other thing is, Warsh really wants to rebuild the Fed from the bottom up, from first principles, and everything is under scrutiny. So a lot of things that were done in the past, we're not necessarily going with the status quo. Everything is up for grabs at this point. So, something that we want to be paying attention to is, again, his statements, what are put out. Happens about once a month. And again, like I said, we have another one coming out this week. So we'll see how that ends up panning out. Okay, so speaking of the data, and he said, like, we're going to let the data speak. What has the data actually shown as of recently? And then after that, we'll kind of look at what some of the prediction markets are looking at for the July decision as well as the September decision. So CPI, which is your consumer price index, the year over year, that has steadily gone up from 2.4 to 2.4 in February. And we see 3.3, 3.8, 4.2. And then a little drop down back in June. But like I said, this has been a steady march up from almost doubling in 6 months. Core CPI is just your regular CPI, but it takes out food and energy, which can swing prices quite a bit, especially in this case, energy was the main driver. So we saw this stay pretty flat, 2.5, 2.6, 2.8, so on and so forth. Non-farm payrolls, these get revised quite a bit, so take these numbers with a grain of salt. Those have been kind of flat to steadily decreasing over time, which not good for not great for the job market. And something that someone pointed out too, especially in the United States, there was a lot of job growth in April, May, June, leading up to the FIFA World Cup, which was held in the United States. So a lot of that is temporary labor, and now that we're past the games, I think a lot of that is going to return to baseline. So we'll see how that plays out. And then the last two on this list are ISM manufacturing and services. So this number, as long as it is above 50, that means expansion, and below 50 means contraction. So as we can see at this point, everything for the last 6 months has remained, for both manufacturing and services, has remained above 50. So at that point, you have had somewhat of an expansion in the manufacturing and services areas. And so that is kind of good for the economy. But overall, looking at CPI, that's going to be your main driver. Some of this could argue that there is room for rate hikes at this point. You have an expanding economy. Inflation is on the rise, especially with in relation to oil prices, non-farm payrolls. Like again, we said he's not too much concerned about the job market at this point in relation to price stability. So that this is going to take less of a front seat, and I would say even these as well. But inflation, I think that could lead to some potential rate hikes in the future. But we will see how that plays out. All right. So what does Polymarket think? We got to consult Polymarket because at this point, if I look at this, what's the Fed decision in July? There is $93 million on the line of people betting. $93 worth of volume in this of people betting what the interest rates will be. So 78% of people think that there will be no change in the interest rates for the July meeting this week, and 19% think that about 20% think that there will be a 25 basis point increase, so a rate hike at that point. The next highest one is 50 basis points, and almost no one is betting that we're gonna see a rate cut at this point. So that is essentially been priced out. That's not happening. September, again, this is a little bit of a ways out. So, it was 93 million of volume on the other one. As soon as July 29th passes, a lot of that volume is going to come over this way. So what are they betting at this point? So there is a 25% chance there's a 54% chance of a 25 basis point increase, which is the highest one at this point. 41% believe that there's going to be no change. And there's about 3% of people who believe that there's going to be a 25% rate cut. So what I'm seeing here is that in both cases, we're either not changing or we're increasing. And as time goes by, the odds that we increase go up, in my opinion. Because again, this conflict has not eased by any means at this point. And I believe that we are actually escalating as time goes by. So that's kind of what we're looking at for the Fed. I'm again either flat to increasing, but I believe that rate cuts are out of the question at this point, unless something miraculous just happens. But I don't see it. So we talk about interest rates in Japan. We talk about interest rates in the United States. But what about the rest of the world? So there's a very clear trend here. These are all different countries. So you got Japan, China, Australia, this is the European Central Bank, Great Britain, Canada. Is this CH? What is that? No, this one is China. And then this one is CNI. I don't know. Maybe I got that. Maybe I got that one mixed up. Anyway, this is the New Zealand dollar at the bottom here in pink. But the main point of this slide is to see what the trend is. So from 2017 on, we were 0% interest rate for a long time following the great financial crisis in the early 2010s. And then countries around the world, they started hiking rates again. It's like, all right, well, we've gotten on the other side of this. And then it's all going up, and then we see them start to cut rates into COVID. 2020, COVID happened right here, and we see everyone immediately go to pretty much 0% interest rates. That caused a huge inflationary spike along with other things. And around 2022, everyone in the world started hiking rates again to kind of get inflation under control. Held for several months, about a year. So between 2023 and probably mid 2025, or 2024, I should say, everyone kind of held rates, and then now we're in a bit of a cutting cycle, and have been for quite some time. But what I do see here is that this seems to be rounding, and that we may be going back up for the interest rates too. So this was just a straight down drop, and then it looks like we're kind of bottoming out. Europe is hiking rates, Australia is hiking rates. U.S. has been cutting, but I think it will probably be hiking rates as well, and so on and so forth. Japan is the key one right here, right? CH is the Swiss franc. I'm sorry, CH is the Swiss franc, and CN is China. Japan has been hiking rates steadily since 2024. And I believe that we will continue to see that, and there's no signs of them slowing down. So we could be at 2% for Japan by the end of the year. Not maybe by the end of the year. We'll see. But I do believe that will still be some type of interest rate hike that we'll see across many different sectors or countries. The other thing that I'll get into right before we start talking about stocks and what who wins, who loses, is government bonds. And there's been a lot of movement here. So we talk about the 5-year bond, the 10-year note, and then the 30-year bond as well. So what do each of these mean? So the 5-year bond is basically the policy bond, in the sense that decisions that are made by policymakers now could affect the 5-year bond, because most people have terms of about 4 years. So policy is really important. The 10-year bond is the benchmark. What that essentially does is that sets the rate. It sets the risk-free rate for everything else. So all calculations are pretty much based around the 10-year bond yields and bond values. And that's basically what sets your mortgage rates, your relationships with the 2-year interest rates, and its recession signal. So 10-year is the most important out of the three. And then your long-term bond is going to be your 30-year. So think, insurers, pensions, things like that. People who are betting long-term on the success or failure of a country and their currency. So the 30 years, like, hey, we believe that this currency is going to be around and be stable for 30 years. So as the yields increase on those bonds, that's not necessarily a good thing, because that means that the bonds themselves are getting less valuable. They have an inverse relationship. So as the value of the bond goes down, the value of the bond yield has to go up until it reaches some type of equilibrium. Reason being is the interest rate, the money that people get back, the coupon rate, that has to go up, so more people will be interested in buying that bond, and keeping that in circulation. So when your bonds get less valuable, the country gets weaker, and so on and so forth. We see that happening with Japan, and so on and so forth. Even the United States to some degree as well. So we'll look at that country by country to kind of see who is doing what, and go from there. So I'm going to show you two different charts here. Each one of them has three things. So this is the 5-year bond yields. I was talking about bond yields, 10-year bond yields, and 30-year bond yields. So we see they range anywhere from like 2 to 5% for the 30 years. The 10 years, anywhere like 1 to about 5%, and 5 years is anywhere like 1.5% to 4%. So they're all kind of in the same range. But again, when you're talking about interest rates, these are the rates on deals that could be hundreds of thousands, millions of dollars, potentially, corporate loans, billions of dollars. So these small fluctuations, 0.1%, 0.2%, 0.5%, those things matter. They matter greatly, because those are your interest rates, and it's the cost of money, the cost of borrowing money. Well, the yields. Like in this case, we're talking about yield. So it's what actually gets paid back to you. So the higher this number goes, the weaker the bond actually is. So this number going up is not a great thing for the country. It's cool if you are a buyer of bonds and you see something that is increasing in value. But again, if you're the issuer of the bonds, then it's not great, because you're not getting the value for it. And so again, like you see that these are relatively straight lines. This is an absolute value chart. So this is one here, and this five here. I'm going to show y'all another chart that makes this pop a little bit more. Pay attention to the red line because that is Japan in all cases. We see that most of these are flat, but Japan is on a steady little uprise. So if I change this to a percent increase, we're going to see something else. So I changed this over here to a percent increase. So from the start of 2026, we see that in this case, back here, it was the Australian, British pound, US dollar, those yields were way up. But if I'm looking at it now, Japan's is increasing steadily, which means that their bond values, I said they have an inverse relationship. Their yields are increasing by a high percentage amount, and their bonds are decreasing in value. So that Japan is in trouble. Japan is definitely in trouble in that respect, and we see it across all of their maturity dates. So 5 years, 10 years, 30 years, and so on and so forth. Their bonds are getting weaker, their yields are getting higher, and that puts a major strain on their economy. And since the yen carry trade, as we talked about before, is a thing, that puts stress on that trade as well, which has helped to prop up our economy as well. So this is not just something that's happening in isolation to Japan. It is happening across the board. So again, like I said, something to pay attention to. This is a data point. Okay, so we talked enough about interest rates and yields and all the other stuff. Like most people are a little bit more attuned to what's going on in the stock market, um, and this is what the stock market sectors are looking like at this point. So overall, my last forecast I used the same chart, and this is looking at the different sectors. So XTL is your telecommunications, XLE is your energy ETF, XLK is your technology ETF, this includes a lot of AI and tech companies. XLI is industrial, XLRE is real estate, and so on and so forth. You kind of get into the weeds down here, but the ones to majorly pay attention to are the ones right here that are winning. And so what do you have? You have XTL, which is telecommunications. XLE, I talked about energy being a major winner this year. So from the time I started talking in April, it really kind of actually had a downtrend. But as we can see, things have started to heat back up, and I think this trend is going to continue. What really surprised me, was X. What's that? XLK. This is the technology ETF. So it was essentially, this is this gold line if you follow it. It was essentially in dead last. The only thing that was higher than it, this was lower than at this point, is XLF, and I'm not entirely sure what XLF is, but anyway, it was second to last in April, and it just had a massive rally from April to May to early June, and just kind of staying here. And it's been consolidating ever since, and I think it will go back down. But this was impressive. I was not expecting that. But yeah, was able to get some trades off there for sure, and catch some of that rally up to the top. But I do believe that that's a peaking signal, and now that we see that these kind of go in reverse, so the energy, this blue line here, as that goes up, this ALXLK and some of the other ones and most other things, they tend to go down. And from here, crude oil and energy prices went down, and we see stuff started to raise up a little bit, especially AI. But now we see that energy is back on the rise, and tech is falling, communications are falling, so on and so forth. But I think for sure these three will be pretty good in the portfolio for the rest of the year. I think we'll see some type of drop in XLK, but for the long term, they're going to keep pumping money into this. There's no way around it. So we'll see. We'll see how that works. But at this point, like I said, I believe that energy is going to be a huge winner this year, and in coming into the following years. I think we're in the start of the commodity super cycle. And I owe you an apology. I was not really familiar with your game, so I gotta apologize to the tech sector at this point because again, dead last, and they just absolutely blew it out the water. So that was the big reason for the surge in equities over the last several months. And yeah, I think we're kind of back to reality. But I did think this was funny for sure, just because I was not expecting that at all. Talk about M2. So this is your money supply. M2 is a measure of the money supply that includes cash, checking, deposits, and non-cash assets that can be easily converted into cash. So things that are liquid, things like stocks and so on and so forth, bonds, things that can easily be traded back and forth into cash. So that's M2. It is one of the most important numbers in all of finance because that is your overall money supply. Um, as that is contracting, the value tends to increase. And as it's increasing, the value of each individual dollar tends to decrease, and so on and so forth. Asset price asset prices tend to rise as M2 rises, and we'll see that. I got some charts here upcoming. But overall, it is a key number that you want to pay attention to. And so, how does it look? This is a graph of M2 money supply going all the way back to 1960, essentially. And we saw a gradual ramp up till the 90s. Okay, we started moving a little bit. The slope has increased. We're going a little bit faster. Post.com bubble. We hit 2008 somewhere in here. And we see a spike there, kind of cooled out until 2011. There were some banking crises around 2011 too, and it increased again. What this is essentially is an exponential curve. It's just an exponential curve, and the big jump came in 2020. As we can see, this area right here is different than all the rest. Spike the slope is still very high, but this is a huge jump. We'll zoom in a little bit on the next slide. Again, I believe that this is an exponential curve. We're going to see that increase. So overall, stocks may drop temporarily, and I do believe in the near future we will see some type of major correction. But I don't think that this M2 curve is going to slow down. I don't think it can slow down at this point, just based on where we're at. Okay, so what happened to M2 post COVID? So I said there was one area of the chart that was uniquely different than the other ones. So we had COVID right here. This is your M2, and COVID happened, and they just printed a boatload of money. So we went somewhere from around like 15 trillion to 18 trillion, printed trillions and trillions of dollars in the span of a couple months, and continued to print all the way up to 20 something trillion in 2022. This is the high point. They started cutting rates in 2022, and we saw that the M2 money supply started to come down. In 2023, you saw your low, kind of June-ish of 2023. And then from there, they've started back to printing again. This is the magic. M2 is your magic money printer. Everyone, you hear people talk about, like, what is the money printer doing? This is what it's doing. So what am I looking at? From the low here to current day is about 2.5 years. And in that 2.5 years, we had printed $2.1 trillion. So that translates roughly to about $850 billion a year, $850 billion a year since late 2023. That's a lot of money. That's a lot of money that we're printing into the economy. And at this point, I mean, a lot of it really is just to help to pay interest. And at that point, you get into a debt spiral. So it's not the best thing in the world, but it is what it is. You got to ride the wave that you have. So I talked about looking at assets in reference to M2. So all of the lines that you see here, this is NQ divided by M2, which is your NASDAQ divided by your M2. GC is gold, CL is crude oil, and then the orange is Bitcoin. Divide all of these divided by M2. So you take your asset and divide it by how much money is being printed. And that gives you a relative rate. So this is from starting in April. The thing to hold since April has been stocks. The one thing that I didn't want to be in at that point because I thought it was dropping. I'm still standing on that. Like I said, I think we're going to see a correction here soon. But overall, stocks beat the money printer since April at this point. Bitcoin did for a time up until about May, and then it just crashed, and the money printers started beating it. So what do I mean by beating it? So anything below this line means that the money printer was accelerating faster than the asset was growing, or if the money printer was stagnant, then the asset was not growing as fast either. So it's a relative rate. It's a relative rate is what we're looking at. And so at this point, you could have had Bitcoin or the Nasdaq up to this point. There's been some sort of divergence, but since April, stocks have been the thing to hold. I don't think that's going to continue, but we'll see. What I do see here as well is crude oil. Crude oil had a huge rally at the start of the year. And we'll see that in the next slide. But since July, it has been creeping its way back up. It fell off and it corrected back down to more normal levels, but it's has steadily been creeping up for the entire month of July. And so I looked at from April on in the last slide, and this is year to date. So this is starting from January 1st. Um, Crude oil won. Crude oil won overall this year. Holding energy stocks and having exposure to crude oil is it was key for 2026 just because you did have this major rally in March and into April. Gold started the year off pretty strong, but then it kind of petered out. It's petered out lately. This is a pullback. It's not something that is structural. I still believe that gold is going to do phenomenal in the coming years, and I'll show that on the next slide. Stocks had they had a pretty crappy start to the year, and then they rallied through April into June. And finally, you have Bitcoin, which has just had a crap year overall. It has not been great for Bitcoin. So if you're short selling Bitcoin, you're having a ball. But otherwise, this has not been the time to hold Bitcoin. It will be in the coming months, but not. And now we're going to zoom out quite a bit for 2000. So major assets versus M2 since the year 2000. Same colors. So what I see here is a few key things. What I see here is if you've been holding stocks since the year 2000, you've been kind of running in reverse. It has not outperformed M2 really at all since 2002, which means the money printer has been moving faster than the stocks have been appreciating. Gold, you've been a winner. If you've held gold for this whole time, especially in the last like 3 to 4 years, you have made massive gains for sure. And you have crude oil here in green. It had a great run up until about 2008, the great financial crisis, and then everything else from there has been a steady downtrend. I do think that's going to start reversing, and that's why I'm bullish on energy stocks. We see it's kind of sitting right at zero at this point, so I think that will continue to rise one way or another. And then the other one is Bitcoin, and this chart actually mitigates and dampens the effect because like if I was going all the way back to 2011, 2012, this chart would blow everything else out the water. But even if we look since 2020, which is around the time I think a lot of people really kind of got hip to Bitcoin and all other things crypto, it has massively outperformed everything else, and it's going to continue on that streak. So, a rise up to the bull market peak here, and then a fall down. Another rise to the bull market peak here, which outperformed even this, and then another ramp down, and we'll bottom out and then continue to go up again. That's just a general pattern. That's not going to change. So overall, your best bets at this point: gold, Bitcoin, and crude oil. I think crude oil as well. Stocks, not so much. But what I believe that we're in the middle, again, I'm going to say it, is the commodity super cycle. Crude oil is a commodity. Bitcoin is a commodity. It's classified as a commodity at this point. Gold is a commodity. Silver is a commodity. These are going to do very well. Stocks have their day, and gold has its day, and we'll talk about that in a bit. Overall, the gold and Bitcoin standard. You want to be holding things that are real, that are Bitcoin's not quite tangible, but things that have scarcity. Gold has scarcity. Crude oil has scarcity. Very real scarcity that we're seeing right now. Silver and gold have, like I said, Bitcoin has scarcity as well. So if you're looking at places to put your money, you want to have it be something that is scarce. And Bitcoin and gold meet that standard. Talking about metals a little bit in the metals market overall. So you have different metals here. So you have aluminum, HG is copper, MGC is gold. This is silver down here, platinum and palladium in green, platinum and blue. But what do I see here? What I see here is, if you look at this in context, this actually makes sense relative to stocks. What has won so far? Year to date, copper and aluminum have won. And what type of metals are these? These are very industrial metals. You need these for AI build out. You need these for any type of technology and communications. So that makes sense that since April, these ones have continued to they continue to elevate to be above the rest of the pack. Gold and silver, this is a cool off period. We see silver had a huge run up here. Gold had a huge run up as well as palladium and platinum. But realistically, these are your precious metals. They are great for being stores of values. They're great for chemical inertness. They're good for the monetary component to it. Platinum and palladium, they do have some industrial uses as well. But yeah, overall, for right now, your precious metals aren't going to be as important. But I think this is a good time to start accumulating because we are going to see another rip up. It may not be until later on this year, but I still have it in the cards that we're going to do pretty well on gold, silver, and the rest of your precious metals. So this is a ratio. This is NQ divided by GC. So this is your spread between the stock market and the price of gold. So what is this telling me? So when this chart goes up, that means that the NASDAQ is outperforming gold. When this chart goes down, that means that gold is outperforming the NASDAQ. And in this case, we see that since the year 2000, roughly, gold was what you wanted to hold. This chart was continuously going down all the way until 2011. And then since about 2011, you had the tech boom, the Instagrams and MySpaces, the Twitters of the world, and all the different tech companies that boomed around 2012 to the 2010s, really. And we saw this major run up for stocks. It was just a great time to be in stocks. And there's a season for everything, right? So this was roughly a decade. This was about a decade. And we see now it's just churning down slowly. So it was good to be in gold in 2022, and then it was good to be in stocks in 2023. From 2024 on, it was good to be in gold. And then this year, for the most part, it was good to be in stocks. But what I see here is this is a range. This is going up and down and up and down. This isn't like a constant move up like this was. This was also a range to where it flipped back and forth. This is a run up. So since we're in this very large range, what I see is that, okay, we've run down, we've gone all the way up and touched the top of the range. And we see now the July candle, which is going to close in about 6 days or so. We see that coming down. And so now I think that gold does potentially have the chance to see some other type of rally. One of two things will happen. Either stocks will come down or gold will go up. I think it's more likely that stocks end up going down at this point. But again, we'll kind of see how that plays out. But for right now, what I see is that we've touched the top of this range, and we've kind of touched the top of these highs as well too. So you have two. You have the range high in this diagonal, and then you have kind of like this series of highs here: 1, 2, 3, 4, and you've had a touch here. So that ratio could come back down to the low fives, and maybe it could break below. Who knows? But I do think that we're in a gold period, a gold rush, you could say. And since we're talking about the gold and Bitcoin standard, I do want to talk about Bitcoin. We're kind of wrapping up here. I got a couple more slides, but Bitcoin we kind of look at the trajectory. So the ETFs got released. This is ETF, spot ETF inflow. So as people buy these ETFs, the ETFs, they need to buy Bitcoin to satisfy that. And sometimes they sell Bitcoin as well. So there's institutional buying and selling. Overall, what you have is when the ETFs first came out, we see the green completely dwarf the red. A lot of buying, it's kind of neutral here. A lot of buying, and as we see that buying increase, so did the price. As we saw that buying increase, so did the price. As it was neutral in here, price chopped, so on and so forth. And there was more selling here than there was buying, price went down. As institutions started to buy, price went up. It was kind of neutral here. We saw it chop. A little bit of a price increase. This was your peak. And ever since then, it's been we could say pretty honestly that the red outweighs the green. So there has been more outflow than there has been inflow. And price has reflected that. So price has continued to go down from, I don't know, what is this? October at the peak here, roughly 125, all the way down to current day, losing 50% at roughly $65,000 per Bitcoin. So ETFs play a large role now. They are a structural piece of the Bitcoin price, and it's something that needs to be paid attention to. The reason that I'm not really worried about Bitcoin's price, and I know that it's going to continue to go back up, is that regardless of what's been going on, the amount of Bitcoin that is available has been decreasing. So this chart is Bitcoin exchange reserves. So how much Bitcoin is available on reserves at this point? So since January of 2024, ETFs were released right here. You had your halving right here. We see that this has been a very clear downtrend in the amount of Bitcoin available, to the point where we were up 3.2 million down to 2.7 million roughly. So that's 500,000 Bitcoin in the span of, what is that, 2024 to 2026, in the span of roughly 2 years. That's a lot of Bitcoin. Again, there was only ever 3.2 million. So if we say every 2 years we're going to take up 500,000 Bitcoin, okay, well, that's going to go away pretty quickly. The other portion of that is that we have a halving in roughly April or May of 2028, which is going to make Bitcoin even more scarce. That's one of the real engines and why Bitcoin is so valuable, is these halvings. So this chart is going to get more and more steep, and it's going to continue to go to the downside because there will continue to be less and less Bitcoin available. I am as optimistic as Bitcoin right now as I was in 2023. Nothing has changed. I'm actually probably even more so at this point. But we'll see. I don't see anything that would hamper this to cause Bitcoin to not be as successful as I know it can. Talking about where Bitcoin is relative to price, you have your Bitcoin realized price. That is this orange line here, and the actual price is this multicolored line. And this is the days until the next halving. I was talking about the halving just previously, but what I am looking at here is the fact that Bitcoin relatively stays above its realized price at almost all times. When it does go below, that is a fantastic time to buy, because chances are it's going to go right back up. And then it goes below, it goes right back up. It might touch here again, go right back up. And I'm looking here. Bitcoin generally spends 122 days below its realized price. This was 300 days below its realized price. This was 140 days, 179. So we can say it spends roughly, 150 to 200 days below its realized price. At this point, we haven't even seen Bitcoin go below the realized price. So when I say I think we have a little bit more ways to go down, we have some more ways to go down. But this is not a bad time to start dollar cost averaging and getting more exposure to Bitcoin, because if history repeats itself, and I said I don't think there's any reason that it would change, Bitcoin is going to continue to go up after we spend a little bit of time under the realized price. And extending from there, Bitcoin realized price is actually split into two different components. So you have short-term realized price and long-term realized price. Short-term realized price is any movement less than 155 days, and long-term is just the opposite of that, so greater than 155 days. This is going from July of 2020, so we see, hey, all this time it's spent above the short-term, it dipped below, it had one more breath above, and then that was it. And then we saw, okay, well, it dipped, it was above, it had that final push up, one dip below, then this last breath, and then now it's below. So Bitcoin price tends to, if it's below the short-term holder realized price, chances are it's going to keep going down until it finally breaks above there. That is a good swing signal, I guess I would say, is like, hey, if I wanted to sell Bitcoin from January 2022 all the way to 2023, that would have been prudent, just because, again, it was below your short-term holder realized price. From early 2023 on, it was a great time to hold. And this was around the time that I started talking about Bitcoin, was early 2023, after it had broken above here. All the way through, I started talking and didn't stop talking until around here. Until I was thoroughly convinced that we are below this moving average. It's not going to come back above, and we just keep on going down. So interesting time for sure. Good stuff to see here. And finally, the long-term holder realized price. This is going back even further. So, well, actually, it's going back at the same time. But what this is saying is that this does not stay below the long term holder realized price for any real amount of time. This is what I would consider somewhat of a hard floor. And we haven't even touched it yet. So I do want to see it touch one time before I'm really convinced that Bitcoin's going anywhere. But once we do get that touch, it is absolutely a fantastic time to buy Bitcoin because at that point it will be up for some time until again you see that short-term holder realized price really collapse under Bitcoin's price collapse under the short-term holder realized price. Okay, so this is it. We're wrapping up, guys. Thank you for staying along up to this point. So the overall chain of events for Q3 and beyond. I actually just took this slide from the Q2 video and put it here. I added a little bit and changed the order up just a bit, but we're already at the loss of production. That has happened. 20 million barrels a day lost. We are currently 150 days into the closure. And the closure, what I said last time, is the closure length is what decides the severity. 5 months is pretty severe. That's pretty severe. I was thinking we maybe a couple weeks to maybe 3 months, but here we are at month 5 with signs of escalation and no signs of de-escalation in sight. What happens next? What we're seeing now, the crude oil inventories they lower. So that's your SPR. Let me see if I can go back here. Where is it at? Your strategic petroleum reserve is right here. So strategic petroleum reserve that has fallen dramatically at this point. That is happening. We're right here, and we're about to hit lows too. So not a great thing. Nearing record lows. Crude oil demand destruction. So in 2020, we actually had um, there was a supply. Well, actually, no, there was more supply than what we needed, so prices went down. This is the opposite now. So we have less supply than what is generally needed, so price has to go up. If supply goes down and price goes up, eventually demand comes down as well because that price is going up until it reaches equilibrium. So eventually you will get, if prices keep going up, you will start to see that demand crush coming. And this has already happened in Asia with fuel rationing and changes to the way that policy is done. Um, so we'll see how that ends up playing out. But how this keeps on going is as price goes up, inflation is forced higher. As inflation goes up, the U.S. and Japan and people like that, they hike rates. I talked about that to where we could potentially see another series of rate hikes. Higher for longer is what they call it. And energy and food would be the main drivers of inflation. We'll talk about that at number 6 as well. Rate sensitive assets begin to fall. So what happens there? You have stocks, crypto, risk assets tank, housing market is strained, and the thing that we see is risk assets. They're already at like great financial crisis, .com bubble levels. These are not normal times, so a fall and a correction would not be out of the question. It would actually be, in my opinion, somewhat expected at this point. So this would only exacerbate things. I talked about crypto. I think crypto is the exception. Bitcoin will still follow its 4-year trajectory. It's going to become more valuable, especially as we start to see some of the other major assets start to dwindle. But like I said, there will be a time for to buy Bitcoin. I think that's a couple months down the road. What's going to happen initially is I think there will be a drawdown for Bitcoin, but it will not go down as far as some of the other ones have because at this point it's already gone down roughly 50%, and we're touching our realized prices roughly. And lastly, and most tragically, you start to have food shortages, and the reason for that is crude oil is a major source of agricultural supply. So fertilizer, especially fertilizer and diesel for the large tractors, your transportation with the semis. If you have a major breakdown in agriculture, that is going to hit the food markets and transportation as well, like I was talking about with semis and stuff like that. So I do suspect that you will see some type of widespread supply chain issues if we do not get this under control. And again, I don't know. I don't have a crystal ball. I don't know what the future is, but what I can say is that if we continue at this rate, it's not going to be great for most people. But I talked about the winners and losers in the previous video. What stocks kind of lead the pack, and which ones are going to kind of falter. Um, I would take a look at that. This video is a continuation of that last video, and I'm going to keep building on this narrative because, like I said at the beginning, there's not really anything that I would change majorly from what I said 4 months ago, with the exception of the major rally on tech stocks. That was the only real thing that I missed from last time, but the overall trajectory is still intact, and I would not change that. So. Okay, that was a mouthful, y'all. Thank you for staying along this much. This has been Chris Talks Crypto. Really, it's more so like Chris Talks Commodities at this point. Definitely, thanks for watching along. If you have any questions, I'm definitely open to answer those. Reach out to me on Instagram and YouTube, both at Chris Talks Crypto. And as always, I will see y'all on the moon. Take care. Bye bye.